Is the Bitcoin bottom in? According to DataDash, everything hinges on whether Bitcoin can hold one critical level, $71,000. As long as we stay above it, a bullish pattern targets 96,000, but an immediate threat looms. CryptoRover highlights that the last 6 FOMC meetings triggered at least a 6% drop within just 2 days, and a bear flag is forming right now. Adding to the caution, Cowen points to a major risk-off signal. He shows stablecoin dominance just soared to 12.5%, a pattern that historically suggests capital is flowing out of assets like Bitcoin, setting up for a potential lower high. However, Jebb provides the ultimate bull market signpost to watch. He's focused on the 20-week EMA at $82,000. A sustained break above that line has kicked off every major bull run, but a rejection could send us tumbling back below 60,000. So we have a key support level, a historical Fed threat, a macro warning, and a clear bull trigger. Which one will break first?
In the latest video from DataDash, Paul Sampson breaks down the big question on everyone's mind. Was the recent dip to the $59,000 to $60,000 range the bottom for Bitcoin? He points out that while the market is showing renewed strength, it's not time to get overly excited just yet. The most critical level to watch is 71,000. As long as Bitcoin stays above it, the outlook is positive. A key technical setup, a bullish shark harmonic pattern, suggests a potential move up toward the $93,000 to $96,000 region. This move could take a few weeks or months to play out. He also touches on Ethereum, which is showing signs of life with its own bullish pattern, targeting $2,900 and potentially $3,800. Interestingly, the overall market sentiment is still in extreme fear, which historically can be a signal that a significant move higher is on the horizon. It's all about whether Bitcoin can hold that key line in the sand. The video's focus on the $71,000 level for Bitcoin remains highly relevant, as recent market analysis shows this area, along with the broader $69,000 to $74,000 range, is a critical zone of contention. The speaker's reliance on technical patterns like the bullish shark harmonic is a classic approach, but current market dynamics are heavily influenced by macroeconomic factors. For instance, the Federal Reserve's FOMC meeting concluding on March 18th is a major event that could inject significant volatility, potentially overriding purely technical setups. While the video correctly identifies that market fear can be a contrarian indicator, the Fear and Greed Index remains in the fear territory, suggesting cautious consolidation rather than outright bullishness. Institutional flows provide a mixed but generally supportive picture. Spot Bitcoin ETFs saw strong net inflows last week, with major players like the former MicroStrategy continuing their accumulation, which underpins the market structure. Ethereum's situation is also nuanced. While it has shown strength by breaking key resistance, it's considered structurally weaker than Bitcoin by some analysts, and its next move could depend heavily on whether Bitcoin can maintain its upward momentum.
In the latest video from CryptoRover channel, there's a major focus on the upcoming FOMC meeting, which is just hours away. Historically, the last 6 of these meetings have led to Bitcoin dropping by at least 6% within 2 days. The video points out a significant bear flag pattern forming on Bitcoin's chart, suggesting potential downward movement. A critical resistance zone is identified between $69,000 and $75,000, a level that has previously acted as a liquidity grab zone. The speaker reveals they have a whopping $20 million in orders set up, playing both sides, with short positions planned for the resistance area and long positions lower down to catch a potential bounce. Interestingly, the video highlights that Bitcoin often rallies during wartime, a counterintuitive but historically observed trend. Another bullish point is the consistent buy pressure coming from Michael Saylor's company, STRC, which is accumulating Bitcoin aggressively. The speaker believes this market cycle is different from previous ones, but maintains a long-term conviction that Bitcoin will ultimately move higher, which is why they continue to accumulate daily on the spot market. The video's focus on the FOMC meeting's historical impact is timely, as markets are bracing for volatility. The pattern of Bitcoin dropping after these meetings is well documented, often attributed to a sell-the-news reaction, where traders de-risk. However, some analysts note the current market structure is different, with less leveraged long positions, which might dampen a potential sell-off. The technical analysis pointing to a bear flag and a significant resistance zone aligns with a cautious short-term outlook. At the same time, the fundamental points about institutional accumulation, especially from players like MicroStrategy, and consistent ETF inflows provide a strong counter-narrative. This creates a fascinating conflict between bearish technicals and bullish long-term fundamentals. The mention of geopolitical events acting as a potential catalyst is also relevant, as conflicts can drive a safe haven narrative for Bitcoin, though it often behaves more like a risk asset in the short term. This leaves traders in a complex position, weighing the Fed's immediate influence against a backdrop of steady institutional adoption.
In the latest video from the Cowen channel, an unfortunate pattern for Bitcoin is laid out, stemming not from its own price action, but from the behavior of stablecoins. The analysis points to the combined dominance of USDT and USDC, which recently broke out, pulled back, and then soared to 12.5%. This is a pattern seen before in other assets like Bitcoin dominance and Palladium, where a big breakout from an accumulation phase is followed by a pullback that becomes a higher low before the next major leg up. This suggests that money is moving out of riskier assets. The video argues that Bitcoin's current rally is a typical bear market bounce, similar to what happened in previous midterm years, like 2022 and 2018. It's noted that Bitcoin consistently finds a low in February and then rallies into March, only to form a lower high and sell off into the summer. This cycle seems to be repeating, despite many hoping this time is different. Furthermore, Bitcoin has been underperforming against gold, energy stocks, and the S&P 500, which is characteristic of a late business cycle where capital flows to safety. Cowen's technical analysis presents a compelling case for caution, grounding his perspective in historical fractals and the inverse relationship between stablecoin dominance and Bitcoin's price. His theory that rising stablecoin dominance signals a risk-off environment is a classic interpretation. However, the market structure in March 2026 has evolved. The continued institutional adoption via Spot ETFs, which saw net inflows of $767 million in 1 week of March, introduces a new steady demand dynamic that wasn't present in the 2018 or 2022 cycles. While Cowen points to Bitcoin's underperformance against assets like gold, other analysts note that since early March, Bitcoin has actually started to outperform both gold and the S&P 500, suggesting a potential rotation back into risk assets. The market is currently consolidating around the $74,000 level, with the Federal Reserve's upcoming interest rate decisions being a major catalyst that could either validate the lower high thesis or invalidate it by pushing prices through resistance. In the latest video from Jebb channel, the discussion centers on the single most important technical signpost for Bitcoin's return to a bull market, the 20-week exponential moving average, or 20WEMA. The video explains that historically, a solid break and hold above this moving average has kicked off every major Bitcoin bull run. Right now, Bitcoin is creeping up towards this critical level, which sits at about $82,000. A strong, high-volume push above this price for at least a couple of weeks could be the confirmation everyone's waiting for. However, there's a good dose of caution. The speaker outlines a possible scenario where Bitcoin could rally to the $80,000 to $84,000 zone, hitting the 20WEMA only to be rejected and head back down. This would fit an Elliott wave pattern that suggests one more drop is in the cards, potentially below $60,000 to the 200-week moving average. Despite the short-term uncertainty, the main point is that any price under $75,000 is a fantastic long-term buying opportunity. The video stresses that the actual start of the bull market will likely be a sudden, violent move upwards that liquidates short positions, and it's better to have a position built before that happens.
The video's focus on the 20-week EMA as a historical bull market trigger is a classic technical analysis perspective that holds significant weight for many long-term traders. This indicator has indeed served as a reliable line in the sand between bear and bull cycles. However, the current market structure is different from past cycles, primarily due to the introduction and growing influence of spot Bitcoin ETFs. This new dynamic means institutional flows are playing a much larger role, which could either dampen the volatility seen in previous cycle bottoms or amplify the breakout when it occurs. Recent on-chain data has shown significant accumulation by long-term holders and positive ETF inflows, suggesting that despite short-term price chop, underlying demand is robust. While the Elliott wave scenario for one last drop to the $50,000 to $58,000 range is plausible and aligns with historical cycle drawdowns, the constant ETF demand could provide a stronger floor than in the past. The regulatory landscape is becoming clearer, with Grayscale Research anticipating bipartisan crypto market structure legislation in the U.S. during 2026, which could further encourage institutional adoption and potentially shorten the bear market phase. Therefore, while the 20W EMA remains a crucial level to watch, the market's reaction to it might be less predictable this time around due to these new powerful market forces.
So after breaking down 4 different perspectives, what's the big picture for Bitcoin? Across the board, there's a strong consensus on short-term caution. Analysts are all watching a critical price zone, roughly between $70,000 and $82,000, as the market's next major test. The key disagreement is why. Is this just a classic bear market rally, as historical patterns suggest? Or are new forces, like the massive institutional demand from spot ETFs, fundamentally changing the game this time around? The unanswered question is whether these new ETF inflows can overpower historical trends and macroeconomic headwinds. The key takeaway: the market is at a crossroads.